All right. Hello, good morning, good afternoon, good evening, wherever you are, folks. Welcome to this webinar with FunctionPoint. Thank you all for taking the time. I see a lot of people still trickling in right now, so let's give it maybe 30 more seconds. And let me get my screen sharing going as well. So hopefully, and Ross and Vince, maybe you can help me confirm, are you guys seeing my slide deck?
Looks good, Jim.
Looks good. Okay. Whew. Technical aside out of the way. All right. Well, again, welcome everyone. It is now 10:01 Pacific on the dot. So why don't we get started here and jump in? So let's go with some quick introductions here. We have a few faces online today. So you can, if this is the first time you're seeing me, my name's Jimmy Wu. I'm the Director of Sales and Marketing here at FunctionPoint. I'm joined by my partner in crime, Ross St. George, who's our Manager of Strategic Business Development.
Hi, everyone.
And of course, we have Vince Dong, who's our guest. Vince, maybe can you tell the audience a little bit about yourself?
Thanks, Jimmy. I have the unique pleasure of being in the industry for 35 years now. I consider myself old, and it's a lot of fun to stay in the business and help agencies with three hats on. One, an agency operations hat, two, a finance and accounting hat, and three, a software hat. And one of the reasons why we're here today is to apply our findings and our data in terms of how we're creating information to, for those of you that care, make more money.
Perfect. Welcome, Vince. Thank you for joining. It's always a pleasure to have someone with so much experience in the industry join us and talking about new trends in the industry. So a couple of housekeeping, and we'll jump right in, is in your GoToWebinar control panel, there is a questions module. So if you have any questions throughout the webinar that you'd like to ask, we do have allocated about 10 minutes for Q&A at the end, so we'll try to get through as many as possible. So please don't hesitate to utilize that. And this webinar is being recorded, so we will send a follow-up to all the attendees and registrants with the slide deck that you are seeing right now, as well as the recording of this webinar, so you can share it with others or review as needed. But without further ado, maybe Ross, tell us a little bit of who FunctionPoint is for those of the audience who is hearing us for the first time.
Yeah, awesome. Hi to our clients. We have lots of clients on here. We also have some non-FunctionPoint agencies. Just to introduce it, FunctionPoint is an agency management software. We've been around 25 years now, and the software runs a marketing agency from sales all the way to invoicing and expense management. And at the end of the day, has a gold level integration into QuickBooks. In between there, between sales and between invoicing, is everything from your robust quoting to project management with Gantt and tasks. Resource management is integrated in. And then for the owners on the call, or for the C-suite, for the leaders on the call, market leading business intelligence, because great, we have all the tools, we have the sales tools, we have the project management tools, the financial tools, but at the end of the day, the best part of this is the ability to mine your data, mine your agency to identify trends where profitability can be maximized, where team members either need coaching or a huge high five because they're doing so well. This is where FunctionPoint really excels. As I said, we've been around about 25 years. We have some stats here. About 91% of our agencies that buy FunctionPoint see a return on investment. We invest 15% of our revenue, 15 cents on every dollar goes back into the product to make sure that we are keeping up with current trends, to make sure that the interface is user-friendly, because yeah, software is an ever-evolving thing, so we try and make sure that we're providing a market-leading solution. To learn a little bit more about us, feel free to head to our website, functionpoint.com.
All right. Thank you, Ross. All right, so let's jump in. So before we go into Q&A, we do have a quick poll we want to launch. So you should actually see on your screen the poll, and which talks about, do you feel your agency is pulling a number out of thin air to charge your clients? So when you are creating your quotes or estimates or SOWs, do you feel that you're pulling a number out of thin air?
Well, with agencies, they may actually have thick air, but that's another story.
So we'll give it about, we got about most 80% of the people have voted. Let's give it maybe another 10, 15 seconds, and then we'll see what the responses are like.
Oh, that's fast, Jimmy. Wow.
As you're sitting there after you voted, for those that said sometimes, I want you to think about, when you quote out of thin air, do you know the margin? Are you tracking margin afterwards? Have you thought about the KPIs involved in that? Just some, whoa, look at that, Jim.
Okay. Wow. Okay, we have a lot of, most of us, 59% sometimes, 39% not at all, where they feel they do have a good idea of what they're quoting to their clients, and 2%, only 2% think they're pulling number out of thin air to charge their clients. Vince, what are your thoughts?
Can you give me that one more time, because you said it so quickly, I was trying to listen at the same time.
Oh, yeah, so we got 2% that says almost always pulling a number out of thin air. The majority, 2/3, almost 2/3, 59% says sometimes they pull a number out of thin air, and 40%, 39% says not at all. They're confident.
Less than half. Less than half.
Yeah.
Wow, this is going to be a very interesting discussion after we have had some dialogue. Great.
Okay. Okay. Well, so agencies, you know, we traditionally have about 3 pricing models: fixed fees, time and materials, retainers. You know, these models have been around forever, tested and proven. But over the past couple of years, I think if you're in any agency communities, forums, Facebook groups, there's more and more people talking and bantering about, you know, we should look at value-based pricing model, you know. So you've been in the industry for 30 years, Vince. Curious, what is your definition of value-based pricing, and is this even a new concept for the agency space?
Well, Jimmy, I'll go backwards for a moment, because somehow people have tuned in to hear about some new improved methodology to charge their clients even more money than they have historically done so. And so in terms of going backwards for just a quick second, that's why we had these 3 bullet points before the word value-based pricing. For those of you that make widgets all day long, or produce, let's say, a business card, and only produce a business card for all of your clients, and you know that this job is going to take you 5 hours of time at $1,000. And where I have seen agencies go into the realm of charging a fixed fee and then blowing their time on that, they are themselves fooling themselves to say, well, we're charging $1,000 for this, even though we've spent $2.5 grand on this particular series of business cards. And where I'm getting to value-based pricing, to me, is to make sure that everyone's got the first 3 fixed, or solidly laid down, so that they are making money. Because if we try to jump to number 4 without repairing, adjusting, and making sure the first 3 are good, there's no such thing as heading to number 4. We're right back to that. Well, let's pull a number out of the air and charge this client whatever. So moving from the fixed fee example, if you truly track your billable time on a fixed fee job, and you come in at 100% perfection, that job only is worked for $1,000, you build a job out at $1,000, congratulations. I don't run into that a lot. And as a result, I wonder why people are using fixed fee, because they're constantly writing time off. which then brings me to time and materials. With a time and materials job, if I were to say to Ross, I have a $25,000 job and it will be adding up, we will keep an eye on it, and Ross has signed off on a $25,000 job, it arrives at 32,000. Now, by the time it gets to 30, I'm already 5,000 over, and I take Ross out for a martini, maybe 2, 3, or 4 martinis. And by the time we've hashed out why there's going to be a $7,000 delta, I've done my best to recover the $7,000 overage, as opposed to saying, well, it's too bad, I'm just going to have to eat the 7 and get on with life thereafter. But in any event, I'm tracking the overage against the time and materials job. The key to that is making sure in the first 2 cases that you've got your external billing rates as current as possible. And I've run into so many agencies in the last 2 years that have said, we haven't looked at our billing rates in some time. Might be an idea right now to do so. And if by some strange coincidence, your staff don't get pay raises over the last 2 years, great, don't increase your fees. But if they expect to have a cost of living allowance, or for those of you that are scrambling to keep staff and increase your salaries by 5 or 10%, I have an agency that had to increase their staff salaries 25% across the board earlier this year. That is a significant increase because they could not increase their external billing rates by 25% this year. But more on that in a minute. When we jump to the retainers, and again, this all ties back to value-based pricing. Retainers are something that I don't like using that word retainer, because for an attorney or a lawyer, and Ross says, I'd like to retain a lawyer to help me buy a house. Once that lawyer has eaten up that retainer, he hits Ross up for more. In the agency world, though, retainers are subject to interpretation. And I see a lot of agencies that go, Jimmy will charge you $10,000 for this scope of work per month for the next 12 months. And we'll discuss what our overages are by the end of the year. And lo and behold, I've put in $180,000 on a so-called retainer job. And I'm a big fan of using a client deposit or an advance deposit or just an advance instead of the word retainer, because the word retainer by itself is subject to some level of interpretation by the client. Oh, $10,000 a month? Great. We'll use $18,000 of your billable time, Jimmy, and you're not going to send us an additional invoice for $78,000 at the end of the year. So the 3 pricing models, and I'm just giving everyone a backgrounder before I jump to that 4th one, are extremely relevant if you know that you make X number of dollars on a fixed fee, if you know you make a number of dollars on a time and materials job, and if you know that you are always going to come in square, no write-offs whatsoever, no overages whatsoever on a retainer. So let's now talk a little bit about value-based pricing. I find that the agencies that have a specialization in a certain industry use value-based pricing. I find a lot of B2B shops use value-based pricing. And what on earth is value-based pricing? It can be leveraged on the items, the first 3 items that I had mentioned earlier. And a lot of it has to do with that person that said we pull a number out of the air. A lot of that has to do with, we know that we can look at a client's budget, ratchet back the time we're going to spend on it because we're the only game in town, and effectively add a dollar amount either on an SOW or a dollar amount on a specific project for us to bill because of a number of things, including our level of expertise, our level of, our understanding of the marketplace as it relates to that particular client. Our level of expertise in general in the marketing industry. Part of it also has to do with the ability from a salesmanship standpoint to say, we know that we're only ever going to put $10,000 of billable time on this job. Given what we've done with the client so far, we're going to create a $20,000 estimate, essentially doubling it, and be able to sell it confidently to the client and for this client to sign off on that estimate. And how Jimmy put this all down was, this is not for all agencies. I would add that it wouldn't be a bad idea from an estimating, from a internal executive leadership conversation level, from a review of, well, if we've been really careful tracking our write-offs all of these years, why don't we, because of the experience we've garnered from all of these write-offs, create an extra line from a value or additional amount of billing standpoint. So in closing on this one particular screen, if you are not current with your external billing rates right now, you're not going to have an accurate picture of this value added amount of money where there will be very few hours involved. And so therefore, it is wise to take a hard look at just updating all of your external billing rates. So Jimmy, does that give you a bit of a framework on that question?
Yeah, I think so. So essentially, the suggestion, what I heard is, as an agency, it's kind of like an evolution for an agency into value-based pricing, but you do need a solid foundation to make sure you do have that foundation with your fixed fees, gone through the time and materials, and have a good, and the retainers pricing structure, have a good understanding of those foundations, making sure you can see your profitability on those three. And then that's where value-based pricing, or as you call it, value-added pricing, would be able to kick in. And a lot of that would be based on supply and demand of the market, plus how good your salespeople are to upsell that additional value. Right?
You want to know what these jobs roughly are going to cost you before you start quoting value-based prices. It's good to have some time under your wings and know that an 8-page website costs you X before you start quoting. Vince, the only other model of quoting that we didn't talk about here was going to clients and understanding what the value of the work is before you quote. So as an example, I, as a agency, approach the Los Angeles Kings and we develop a season ticket campaign to boost their sales by $1 million. So I'm telling the client, this work is worth $1 million to you, and I want 20%. That's another thing that we're seeing, another trend that we're seeing in the market is billing based on the value to the client.
You've brought up a separate but related topic, because in virtually every SOW or MSA that I do see, there's a set price for the work, and you're saying this project is worth $1 million, and I want a part of that. So from a clarity standpoint, are you talking about the value of the work that is going to be worth, sorry, not worth, but booked and billed for $1 million, or are you saying this job is only $600,000, but we want $1 million term?
Doesn't matter what it's costing us. We're billing the client X, which was determined based on the value that the work would bring the client. Jimmy, your next slide is a good one to segue into.
Yes, I wanted to kind of, because we talked about value-based pricing, having that solid foundation. So maybe Vince, if you had a suggestion to the audience here, whether value-based pricing is something they should adopt, what are maybe a couple bullets that you would suggest for them to consider before adopting value-based pricing approach?
Every client P&L should be reviewed every month, and there should be a pattern. And with every agency that I walk into, the client P&Ls are different for each and every client. There's rare is the instance that I see that you've got 25 clients and each client is earning 15% profit. That agency would be called robotic, as an example. But we look at a specific roster of clients where we are making a reasonable profit and we are not exerting such an outrageous block of time. So one thing from a data analysis standpoint would be to take a look at where can we improve our margin, i.e. add additional fees accordingly, where the client will be accepting of it, and procurement notwithstanding, that for the efforts that we're putting in, how difficult would it be to raise the profit of these particular clients from 15% to 20%? So the first bullet point that I'm proposing is take a look at where your margins are, where your net profit per client is, and see, in fact, have the dialogue with account services that are servicing those particular clients as to, could we add another $10,000 in miscellaneous items, or say to the client, well, this is really going to take that much more time, even though it won't, to add the additional $10,000 in the meantime. Number two, we're, as an industry, going to be faced with the challenges of profit reductions, largely because salaries are going up tremendously. And there's just a little bit of movement now on the client side to say, okay, our Ross's salaries have increased by 35%. Sure, we'll give you guys a little bit more money. So when we've got a little bit of time before the clients wake up, this business of profit erosion will certainly beg different ways of estimating our work to the clients accordingly. And it's not a matter of taking a look at it and saying, if this job takes 10 hours, we should just bill the 10 hours. What internally, and this is again an executive conversation, what internally could we realistically charge to these particular clients? And we're right back to, it's not for every client. It is for certain select, trusting of the agency based clients. Does that help you out, Jimmy?
Yeah, so the two really I'm hearing here is, one, you should really know your profit margin. If you don't, then that's definitely something you'd want to get a hands on first. And then talk to your salespeople to see if there's a way for us to sell a little bit more, add a little bit more value on top. Or does the client have a little bit more budget to pay for this work? And then, yeah.
Or is there a creative opportunity? So when we're approaching a new account, is there a creative way that we can propose pricing so that the increased value that our project brings meets their budgetary needs? Instead of just quoting out a fixed fee, we can quote on that ROI based, value based kind of model.
Spoken like a true salesperson there, Ross.
Ross, you have, and everyone will always say, well, we only have so much billing room according to an annual SOW or an annual budget. And so let's sort of make Ross meet us halfway. Why not look at an annual budget of a client? Let's use $1 million for the sake of conversation. And instead of spending time putting together a matrix of how many hours we are going to be chewing up, why not in your own minds say, we plan on making $100,000 in just pure value added this year. So we're internally going to start with $900,000 from a budgeting process so that we can actually have that buffer, that cushion available to us. And that way, everyone's a winner.
Perfect. All right. Well, so let's get into a little bit of the nitty gritty. So Vince, you mentioned there's two approaches you feel for value-based pricing. Maybe walk us through the first and the second approach a little bit more in detail.
And for those of you that are reading at the same time, the two of them are close to each other. I'm looking at it in the first case holistically from an annual spend standpoint. And for those of you that don't have the opportunity to have a client's budget all year long and really don't know what on earth the totality of the spend will be, I'm approaching it the same way with individual projects. So we're, as Ross set this slide up earlier, we have a client with a $10 million spend, and perhaps $6 million of it is media. Nothing you can do about that unless you have a unique relationship with the digital media suppliers. And you've got $4 million left in service fees to work from. And in your own minds, because many of you may not have the history or the experience or the intestinal fortitude to say, okay, let's hive away $500,000 from this $4 million remaining budget and work on $3.5 million of work. And you can then be judicious about where you might want to insert that value added line and go on a either campaign basis, go on a particular job basis, go on a unique kind of a job for that to happen in order to sop up the remaining 500 grand. And I did mention the professional judgment component. Part of this is also going to invoke the thinking of the CFO, for example. A lot of it, most of it, for those of you that are independents, will certainly have to have this digested by the principal or the partners or the owners. Another aspect of this approach, number one, will certainly be to lay it down to the account people, because in the historical world, an estimate was based on X number of hours, X billing, Y billing rate per hour, perhaps even a 17.65 markup on outside costs, and you looked at it that way forever. And our conversation today is to say the world certainly has changed a lot in the last 2 years and has had a significant impact on so many aspects of ad agencies. Why not take a look at yourselves, think about yourselves one additional step, and think that what you produce for the client is certainly worth more than just the billable hour and the hourly billing rate. So that's approach number one. Approach number two is certainly similar, and we are just grabbing a select service item line or a billing item line or a function code line in order to augment that estimate. And I can already see questions coming in to say, well, how do we present that to the client? What do we do from a client invoice standpoint? And we've never done this before, so what are we gonna say? This is a two-part conversation. Internally, what can we write up for a dollar amount? And then externally, how are we going to best present it to the client? And if your client is used to having a single line, fantastic. If your client is used to having an itemized line for estimating purposes, well, the easy thing is to either prorate the additional write-up or value-added amount by the different function lines, or if you feel bold enough, you tack that additional example, for example, $10,000 just onto creative concepting as an example there. So how you present it to the client will take you a little bit of thinking time. What you do internally in terms of, why haven't we thought of essentially charging more money for fewer hours, which is really the crux of our conversation today. Okay. So Jimmy, those are the two approaches. Now, I don't know if there's a slide for tracking the value-based pricing income.
Yeah, we do, and we'll get into that with some examples later on. But I wanted to share this slide. Maybe Ross, you want to talk a little bit to this? I think this relates very well into what Vince just mentioned.
So based on what Vince has talked about, you want to, or Vince is encouraging that we still do our quote. We still look at how many hours this is going to take us. We build that out, and based on the additional value that we think that this project can add for the client, or based on the total value that we think we can charge the client, we create that write-up as a separate line item. This is rolling with scenario 2 about what Vince just talked about really well. As you can see on this particular quote, we've got 3 different line items for services: copywriting, design, and PM. Each of those has hours associated with it. Each of those has an hourly rate associated with it, and each of those has a billable value. For this particular estimate that we're looking at here, there's an overage of $4,000, which we're billing in as value-based pricing, meaning the total job is worth $10,000 to the client. We've still built out the quote as far as what it should cost us, how many hours it should take. We've done the back end work, and we see that we've got an additional $4,000 of billable value. Jimmy, if you hit view cost and billable margin there in our system, that would bring up what the margin is going to be on the job so that you can track this moving forward. Now, this isn't the only way to do it. You can do this with other techniques in our system. We've just got this here today to show you based on the scenarios that Vince was talking about. So we're going to track this additional write-up of $4,000 as we talk about reporting throughout this webinar.
Yeah. And keep in mind, I think Vince also mentioned that the client, what you show the client is going to be important. So in FunctionPoint, you will be able to have some options to pick and choose kind of which line items you want to display versus not display as well. So showing just a one-line estimate, or have some of the details broken down without the dollar value showing. So cool. So we had Vince, there's a couple questions I think that came up around time tracking. So a lot of the conversations when we talk value-based pricing in the industry is, if we do value-based pricing module, time tracking is no longer needed. I guess true, in your opinion, is this true, false? What are your thoughts?
I'm pretty violent about time reporting. Ross knows about it. So it is, you have to keep time tracking, period. I'm aware of one agency out there that says we don't track time, and strangely enough, I've never seen the income statement of the agency. But aside from that, the key to tracking time is to make sure that we've got our employees costed against our jobs and clients to see how we've done against this additional revenue, in addition to how we were doing before adding this additional revenue. Because if we put an estimate together for $10,000 and we know that this job is only ever going to come in at $6.5 grand from a time tracking standpoint, the anticipation is $3,500 of value added revenue. So if we stop tracking time, we have no idea how much time was against that $10,000 estimate, let alone what we thought would have been for $6,500. And we can empirically say, we don't know what value added we had, if at all. So it is so key to continue to track time for 2 reasons. One, if Ross is on this job, we want to know if this guy actually came in at $6,500 of billable time on a $10,000 job. Or If Ross came in at $10,000 on a $10,000 job, poof, there went the value-added billing. And we would turn to Ross and go, so we had anticipated another $3,500 of revenue. What happened? Well, Vince, I misquoted, and the client was demanding revision after revision after revision. And I would say, Ross, the story of your life. Maybe you should go back to estimating school and have a better look at that, and which is another reason why it is so key to maintain the time tracking on a job-by-job basis.
However, not everyone's going to do it. Not every agency is going to track time, and we're seeing some agencies move away from it. In that case, it's still important to try and track some kind of costing. So we at FunctionPoint as a team have tried to design ways where we can get some kind of costing for some kind of profit analysis on your jobs instead of tracking time. Jimmy, what are your thoughts on our next slide here?
Yeah, I think this ties well, I think, to the next slide. The concept of write-offs versus write-ups. I mean, Vince, you mentioned in the past that both agencies should track both of these. I think most of us are familiar with what write-offs is, but maybe can you explain to the audience, what both are real quick, and maybe the difference between the two, or how they relate to each other, I should say, and why it's important?
For the general audience, there was just a typo at the very top of the header. It should have been Writeups and Writeoffs, just for clarity, because those are very important nouns after the word write. So for those of you that have what I will call an agency-based project management system where time is tracked by job, we'll go back to that example of a $10,000 job. The estimate was approved by the client, and Ross is in charge of it. In fact, Jimmy and Ross are both on the job. Jimmy is the creative director, and Ross is the account manager. Together, they managed to put in $16,000 of billable time on that $10,000 job. And I'm in charge of billing. And they've tried every which way to get $6,000 from the client. And sadly, what we have to do is write this time off. For some of you who are not using a connected software program and maybe using just an accounting-based program, you never get to track that information anywhere to make smarter estimating decisions the next time this kind of a job comes along. So I'm a big fan of not transferring the time to another job, not leaving the time on that job, and effectively writing it off. In our example here, we've got a $6,000 write-off, and I'm huge on reviewing write-offs each and every month. And at the end of April, I present to Ross, our agency wrote off $150,000 in billable time last month. That's a lot better than the $300,000 we wrote off the previous month. So sounds like you are improving on your estimating, or you're picking different kinds of work to avoid these rather large write-offs. And Jimmy, I'm just going to expand on the word write-offs for a quick second as well. It is so key to have different categorizations of write-offs so that Ross can determine that underestimated work, which is just one write-off category, seems to be the consistent theme under the $150,000 that he wrote off versus beyond scope, internal mistake, client revisions not charged for. So the more he has a data-driven set of descriptions for write-offs, the more he can be more mindful of future estimates for similar jobs down the road. Unless Ross wants to be a not-for-profit organization and say, I'm going to keep doing this and write off repeatedly all the time. So what's key about write-offs is that they get tracked on the income statement. And Jimmy, I love to see cumulatively how the impact of write-off money shows up on the general ledger. There are a couple of programs in the industry that does the posting into the GL, but rather than just taking a look at a write-off report, it's great for the owner of a company to go, so Ross, we've written $750,000 off this year. Our profit is a total of $300,000 this year. And Ross, you are solely responsible for these write-offs. And I'm sure there would be a discussion about future estimating, as well as what kind of clients. And then lastly, Ross maybe attending some remedial estimating classes. The write-ups are my darling. It is so key to equally track the write-offs on the general ledger. And now let's say Jimmy's in charge of a job. The estimate was approved at $20,000. He knew there was no way that he would be spending any more than $12,000 of billable time on that job. And lo and behold, he came in at 12 grand, and the client's going to be billed for $20,000, and we effectively write up the job for another 8 grand and essentially bill to estimate. Now, Ross, we may ask the crowd here to say, in that example, which agency would only ever bill $12,000 on an approved estimate of 20 grand? You might want to wait like 1 second, but that would be about it. Has any agency said, yes, of course? So I'm just jumping back quickly to write-offs for a moment. Then there are the hard write-offs, where we've made an internal mistake, and that particular write-off might be a production cost relating to a printer or some third-party vendor costs that we are simply not going to be billing the client for whatever. So in saying that, we would certainly track those write-offs as well and not bury them in cost of sales. But be mindful that once we've written it off, it certainly has the need to show up on the income statement as a separate line item below something like bad debt expense. There you go, Jimmy.
Okay, that's very interesting. So let's talk about scenarios, because you talked about tracking, and one of the curious cases is especially around staff utilization and realization when it comes to value-based pricing. So maybe in lieu of time, we got about 5 more minutes left, because I do want to go through some Q&A as well. Can you give us maybe a quick rundown for scenario 1 and 2? So in scenario 1, where the staff completes the work below the estimated hours, but then as a result, the gross margin is higher than expected. How would you track, what's your recommendation in terms of tracking staff utilization and realization in this case? Would they get the value of the write-ups that you just mentioned earlier?
So let's sort of break apart Jimmy's questions, because he's asked 3 questions in one large phrase, and we don't want to confuse everybody in that context on slide 14. When we talk about utilization and realization, it's very key to not just look at the client P&Ls to see where we have made more money on the additional income that we're charging. And for those of you that are continuing to do timesheets, this is where it's really important to go, if we put the time in, if we did not actually exceed what we thought we would do, and I'm going to go back to Jimmy's example, $12,000 in billable time, $20,000 estimate. What we have to be mindful of is, who do we give credit to for the $8,000? We know Jimmy did his time. We know Jimmy didn't need to exceed this job. So therefore, from a utilization standpoint, 100% of the marks go to Jimmy. But from a realization standpoint, Jimmy wasn't in charge of creating that estimate. Ross was. So do we give Jimmy the $8,000 in credit? Do we give Ross the $8,000 in credit because of his experience in adding value add to the job, or do we leave it to the house? Do we say the house is responsible for $8,000 of revenue recognition, and in doing this, we may end up having it tracked under a miscellaneous expense where there's no vendor nor employee attached to that record, or we create a new employee called Casper the Friendly Ghost, and we put in 5 minutes of time and $8,000 of billable time against that record for the job to be billed out at $20,000. So I'm just setting us up for that framework of this conversation. And now we go, the staff completes the work below the estimated hours. There are actually two things in play here if we've got a value-added job. Jimmy is going to put in no more than 120 hours for his $12,000 of billable time for a $20,000 estimate. Now, Jimmy only comes in at 100 hours. Fantastic. His utilization and realization together are great, but he doesn't belong in that value-added revenue line for the $8,000 of additional income that we're going to be earning. As a result, let's make sure that we do not confuse this additional, essentially $10,000 of additional revenue, because Jimmy didn't need $12,000 of billable time. Jimmy only expended $10,000 of billable time. So there's 2,000 not value added, 2,000 is actually exceeding utilization and realization, and the other $8,000 is truly the value add. As a result, the gross margin is higher than expected. Now, Ross, scenario 2. Ross exceeds the estimated hours. What do you do here? But we'll use Jimmy's $20,000 example. Ross was supposed to put no more than $12,000 of billable time in there, and we thought we would earn $8,000 in value add, but he puts $16,000 in billable time in there, and we've now reduced the potential for the value add by 4,000. I'm getting a little bit complicated with the math, but the question is, do you want to show only $4,000 in value added as a line item on your income statement? Or do you want to show $8,000 in value added and $4,000 as a time write-off, because that good for nothing Ross blew the budget based on the value added? So I'm of the former understanding, because I'd rather show the inefficiency, the under-realization of Ross blowing $4,000, and I'd also want to show the $8,000 from a value-added revenue standpoint. So I'll repeat that last sentence. We bill the client $20,000. We want to show on the income statement $8,000 of value-added income, but we also want to show on the income statement $4,000 of write-off time, because Ross exceeded his expected billable time of 12,000 to get to 16,000. Scenario 3 is even more complicated, because we've got allocated hours, estimated hours, actual hours. So if we estimated 200 hours on a job, and Ross is once again in charge of this thing, and he tasks out all these people to get this job done, and it turns out that we're going to need 250 hours. He's actually said, without saying it, oh, gee whiz, I created an estimate thinking that I had value-added money in there, when I realized that it's actually going to take me another 50 hours. And what do you do here? Something similar to number 2. You're eventually going to have to create another write-off category called, oops, I didn't marry up my allocated hours to my estimated hours. And that's got to be something useful. I've run into the scenario 3 very often, where Ross just takes off, looks at the sky and says, Vince, it'll be $50,000, without really creating a schedule of the true allocated hours, marrying it up to the estimated number of hours. Vince signs off on $50,000. Jimmy comes back and says, Ross, this job should have been 85 hours. What were you thinking? Well, Vince wasn't prepared to pay. Well, Vince shouldn't be getting an $85,000 job for $50,000. So what scenario 3 really gets you to do is take a hard look at how you're allocating hours, how you're estimating hours, and they should be darn close to the same, how you're tracking actual hours against the estimate or against the allocated if they're not even close. So Jimmy, you've proposed 3 unique scenarios which are live in the industry today.
And what I find interesting is also that this really ties back, if we want to minimize scenario number 3, it really ties back to having a good foundation that you mentioned in the beginning of having a good foundation around your fixed fee, time and materials type of pricing model first before jumping into this value-based approach. So, well, thank you, Vince. So Ross, I know you want to maybe talk a little bit about how FunctionPoint might be able to help our customers report on some of these value-based pricing.
Yeah, so you've decided to do value-based pricing. Now what? This is a report here that we've built into our business intelligence module. So this is within FunctionPoint, part of our module, where we're tracking a job that is a value-based pricing job. We've named it value-based pricing just to clear up the confusion. And what we've done with this report is we've built the write-up as its own separate row. In this case, the write-up on this job is worth $4,000. The first highlighted metric that we're seeing is a margin of $8,200. That is the expected margin with the write-up and with the margin of the expected work. Again, this is a report based on this type of estimate. Not every value-based estimate is going to look like this. The other columns that we've got highlighted are the actual margin, and then the delta, the last highlight, is the delta between the expected margin and the actual margin. So this delta is as an added margin of $175, meaning we made an additional $175 of margin on this job. That is information that you can then use to either, if it's a huge additional margin, maybe compensate. Another report that I wanted to quickly look at is comparing your margins. So this is a report that, again, we've built into the business intelligence module of FunctionPoint, where we're comparing fixed price jobs, retainer jobs, time and material jobs, and value-based pricing jobs. We're comparing those margins. We can do this on a quarterly, annual, monthly basis, and we can see here, based on our demo system data, that value-based pricing jobs have a significantly higher margin than fixed price jobs. So you can start to track this as you're starting to explore this as an agency. Without further ado, I think we should hop into some questions. I'm sorry, we're not going to have time for all of them. Jimmy, do you want to hop onto a couple?
Yeah, so I know we got about 5 minutes left, but I think there are a few questions that are brought up, especially, Leanna has asked about, very good questions. I love them. How can you qualify the potential client or ask the question outside of what's your budget? And I think, Shannon, you had a really good suggestion, get a premium for early delivery or other type of incentives. So I thought that was a good suggestion. But a common question that comes up is, agencies are looking at value-based pricing model because they want to ensure there is a fair and equitable exchange of value between clients and agencies. So they're approaching it from that perspective for value-based pricing. So the question is, why do agencies still based on time, and what do you see the purpose of using time for value-based pricing if their approach to value-based pricing is a fair and equitable exchange between clients and agencies?
It's in the math, and I say this really from being a a CPA, if you don't use time and you invoke value-based pricing, how on earth are you going to be able to track the true worth of your so-called value-based pricing in your estimating process? And it is, I mean, by all means, go ahead and add $50,000 to a job and knock yourself out. It is not a question of being fair and equitable in the exchange of goods and services. It's a question of, well, if you were making 5% profit annually right now and you started jumping into value-added pricing and moved up to 17%, what a significant management directional change for the benefit of the agency. Now, if you're already making 25% and you move to value-added pricing, you'll probably go to 30, 32%. But if you have a concerted focus on doing this, it certainly requires time, entry, to give you the base from where you started from to where you're going to be getting to.
Okay, perfect. So another question that came up, and we just have a couple minutes left here, is do you recommend, do you lean more towards recommending or proposing value-based pricing model for existing or new prospective clients? Or does it matter?
What you have to do is look at yourself in the mirror and go, am I just good enough? Are we just good enough? Are we great? How is it that we have whatever features and benefits we are offering to the clients, for starters? So essentially, you're doing a gut check. The second thing has to do with how well do you know each and every one of your clients? If you've got really, really challenging clients that are always nickel and diming you, one way to skirt out of that one is to say, fine, we'll lower our billing rates as you requested, but when you're doing your estimating, you're going to jack up those hours. So you're essentially skinning the cat a different way. And that can go with pre-existing clients and it can go with new clients. So I'm giving you like 3 bullet points in your question.
Perfect, thanks. So from a margin perspective, what do you see as the average, and this question's from Heather, what are you seeing as the average agency net margin for the year? What should they strive for?
Let me define the word margin. I'm going to throw it out for just a quick second. We live by AGI in terms of gross billing minus cost of sales gives us the AGI. If you want to introduce margin, you're really only taking a look at the labor cost divided by the AGI and subtract the labor cost. I'm sorry. I'm a big fan of making sure that the overhead is included. So in the industry, we use the number 50, 30, 20. 50% labor against AGI, 30% overhead against AGI, and 20% profit. And what we've been seeing in the industry of late, overheads have dropped certainly. And so you're looking more at 50 labor, 25 overhead, and 25 profit. So I think Heather, I'll sort of edit your question. What are we seeing in the average right now? That's what we would like to have. Now the answer lies all over the place. I have seen 5%, I've seen 37%. But if you're not at 20%, you've got some things to take a look at your own agency.
All right, perfect. Now, another question, this one's from Maurice, is there a good range in terms to benchmark against on your net margin, on your margin that you just talked about? What would be a good range, and does it differ for value-based pricing versus non-value-based pricing agencies?
Well, this is Maurice from Montreal. Long time no speak.
The Godfather.
I think you asked a couple of questions, Maurice. What should you be looking at in terms of improving your bottom line if you start going to value-added pricing? How long is a piece of string? And there is no rhyme or reason to it. There is, however, room for you to grow into it. And look, if you are making 25% profit now and you want to aim for 40, you back into the value-added pricing dollar amount and the value-added pricing percentage amount. If you want to just aim for 30%, you move that way accordingly as well. You'll probably need your controller to back into some of those numbers and figures, but you're asking a question that says, where do we want to get to with the control of additional profit? So I hope that helps, Maurice.
Okay, perfect. Thank you. Well, we are at the top of the hour, so thank you all for attending. As again, well, this is recorded. We will share the slide deck and the video recording with everyone afterwards. If you have questions for Vince, his contact information is on the slide deck at vince.dong@vincentdong.com. If you'd like to learn more about FunctionPoint, don't hesitate to visit our website or contact us at sales@functionpoint.com. Thank you all again. Thank you, Vince. Always a pleasure, and hope you all have a great week.
Take care.
Hi, everyone. Thanks for attending.